Alrighty. So, in the earlier panel that literally just ended, Assad said, go where the money is. Well, I brought the money on stage. So, really excited to kick off this panel on a very interesting topic with some of the best investors, not just in RWA, but very much in this space. I'll start off with a round of introductions, but maybe I'll go first. My name is Chinan. I'm a partner at Saison Capital. We're one of the most active VCs in the RWA space in Asia. And I'll start with a quick fun fact before I throw it to my esteemed panelists for today. The fun fact is that there was a study recently on the average time it takes to move a US dollar on SWIFT, which is the archaic network that we know. On average, it takes 18 hours, which is pretty much the time it took for me to fly from Singapore to New York. So I would say what we're talking about is very much needed. But enough about me. What I'm going to do is going to ask each of our panelists here to introduce themselves. But let's spice it up a little, and let's ask them what is their house view on RWAs. We'll start with you, Chris.
Hi, I'm Chris Perkins. I'm the president of CoinFund. We're investors with seed, venture, and liquid strategies. Our house view is that convergence is going to happen. It's happening in real time. And tokenization is at the forefront of that convergence theme. We believe that when we invest, we like to look at things that deliver utility. And tokenization does just that. And what it does is it eliminates, in many cases, something called Herstat risk. If you know history, Herstat was a bank in 1974 that went bankrupt because settlements just took too long. And so here we have a technology that can actually improve the system. The numbers get really big, really fast. We'll talk about it today. But ultimately, we believe in convergence, and I think this is at the forefront of that theme.
Hey there, I'm Nuelle. I co-lead the investment practice at Galaxy Digital. Our house view on RWAs is basically focused right now that stablecoins are a beachhead market. They're working, specifically we're seeing them working for cross-border payments as a sort of replacement for SWIFT in some aspects. So that's the beachhead market for on-chain assets into traditional financial rails. We think this is a 2-decade story. It's not going to take 2 years, it's not going to take 5 years. I think we probably still need a bit of a regulatory kick, some improvements behind the scenes with transfer agents recognizing tokenized assets, but it's a long-term story, and the settlement efficiencies you get from tokenized assets versus the traditional systems across a host of asset classes are real, and we're betting in the long term that this is the case.
Hi everyone, I'm Rob Hadick. I'm a general partner at Dragonfly. We're about a $2.5 billion global venture fund that invests in and around the crypto and crypto-adjacent ecosystem. House view on RWAs, I would say totally agree with Chris with Will on stablecoins. Clearly a beachhead market that we've spent a lot of time in thinking through and investing in. I think as it goes beyond stablecoins and money like products into other types of products, we've been, I would say, skeptical. Not skeptical that tokenization is happening and that we're likely to see a broad swath of tokenized assets come on chain, but skeptical in so much as where that value accrues, how startups actually play in that ecosystem, and what the end state actually looks like for permissionless chains.
Hi everyone, I'm Ash Arora. I'm the youngest partner at LocalGlobe. We are the oldest and largest early stage VC based out of Europe, 2 billion AUM. I think I'm the only sector agnostic fund on this panel. So we do pretty much everything ranging from AI, crypto, but also to traditional fintech. We also, I think, have the highest number of unicorns bagged in fintech out of Europe, including Wise, Monzo, and Revolut. So because of that, we automatically within RWA have a very strong house view of innovation in finance and in fintech broadly. Could be cross-border, could be payment trails, could be basically anything else under the sun that is accruing value over a period of time. Apart from that, we are based in London, and London created estate ownership almost, 300 years ago. And till today, there is this entire asset class of real estate which basically says you can only buy 999-year-old leaseholds. So it's basically stuff like that, which once you kind of solidify into asset ownership, you can actually use RWAs in a very real-world manner. And we are seeing a bunch of very innovative, creative companies coming out of that. So.
Wonderful. Like I said, some of the best investors in the Western Hemisphere with me. So let's give them a little challenge. So what I'm going to do is pose a few statements and going to challenge to hear what their responses are. And let's start with this one. RWA was last year's narrative. We have moved on. Agree or disagree? And I'll throw it to any of you who want to kick the ball rolling.
I'll go.
Chris?
I disagree very, very strongly. Let's start with the stablecoin example. I think, correct me if I'm wrong, the stablecoin market cap's around $200 billion, right? I was speaking to a large bank the other day, and they're like, yeah, you know what, like I sneeze and $200 billion comes out, right? Why? Because it's a $7.5 trillion a day market. 99%, maybe 98 at this point, is US dollar. That makes no sense whatsoever. Only starting with stablecoins, and I actually disagree with you, Rob. I do think there's value that accrues to things like money market funds. But if you think of stablecoins, 3 major streams of utility. Payments, obvious. Everybody gets that. No brainer. The second is collateral. Not too many people understand this. In the aftermath of the global financial crisis, derivatives had to be collateralized every single day. And I think there's opportunities for that in initial margin and variation margin. We are just now starting. I sit on the CFTC Global Markets Advisory Committee, and we finally are about to take to vote saying, hey, CFTC, why don't you ignore the wrapper and look at the underlying asset? Tokenized collateral will make your lives better. So that's the second vertical is collateral. And the third is FX trading. This is a monstrous market. You can't have FX trading if you only have dollars right now. That's going to be a huge market. It improves the market because most of FX today settles T+2. We'll be in a much better spot when it settles in real time.
Cool.
Maybe to kind of respond to you. I don't actually disagree with anything you said, right? So I think stablecoins, payments, cross-border, FX, remittance, collateral, which, I mean, even the collateral are like really money-like products mostly, right? I think money market funds kind of fit in that category. I think the question becomes is, well, where do we go from here, right? And I think, looking around this room, I'm guessing there are a lot of people here who are focused on other types of credit products, or focused on real-world assets, or like, wine and whiskey and, art and et cetera, right? And as I think through like that BCG or that McKinsey report that says, hey, we're going to have, $20 trillion worth of tokenized assets, and it's going to go from what it is today, which is money-like products, into all of these other things, that's where it starts to become, hard for me maybe to see that future in the same way, that exists in, kind of an unregulated world, which in many ways today, stablecoins are regulatory arbitrage, right? And my guess is that, equities, bonds, like things that are regulated products that exist within the current financial system, it'll be really hard to extract those and put them on public chain and put them in a place where, kind of unregulated entities are interacting, or if the regulated entities are being on that public chain. And I think Larry Fink's been very clear that they want to tokenize everything. And so I don't think it is last year's narrative. It is very clear that it is, this narrative that's going to persist. Where the narrative breakdown might occur is at the token trading level. Like, is there going to be another Ondo that trades at $8 billion and they're going to have that venture style outcome? That's where I think the push-pull is a little bit for us specifically, and where I think for startup founders, they need to be very thoughtful about what market am I going after? Is there net new is there net new cash that I can get on chain, or am I actually taking a product that exists off chain, giving maybe a little bit of extra token rewards, and my selling to what a bunch of foundations that don't actually have that much money relative to what exists off chain in those traditional asset classes?
Yeah, I completely agree to that as well. And just to kind of throw some stats, I think there's been a growth of about 56% in active loans in private credit that are within tokenized treasuries in the last 10 months. So I think that just kind of negates the fact that this is last year's narrative. This is this year. Might have happened because of the higher interest rates, but at the same time, it still has happened. It's identified as a new emerging asset class with future potential. I think the narrative this year, like you said correctly, is a little more nuanced as well, and maybe that's because we are based in Europe and we see a lot of wine and whiskey happening. But there are a large number of real-world assets that are actually coming out and are able to create and generate value. Maybe at a very small scale, maybe not in terms of tokens within equities, but at the same time, there is enough validation for the entire narrative that we have seen this year. So I don't really see this narrative going away anytime soon.
I think my opening statement sort of said where I stand on the issue, since I said it was a 2-decade story here. But I mean, I think fundamentally I generally would agree with Chris. I push back on this idea that it was last year's narrative. First and foremost, I don't think, with the exception of one token in Ondo, I don't think there was much of a RWA narrative to begin with. I think I agree with Rob's pushback, which is that there's just not that much native on-chain capital in comparison to the native off-chain capital. And so if you're selling financial products, off-chain financial products to on-chain capital, which has been sort of cumulatively or built up over, in a compounded way, built up since really the ICO bubble in 2017, that capital sits on chain, and now we're serving off-chain financial products to that latent capital. That's all well and good, but it's not that interesting of a market. I like Chris's point, which is now you have to kind of bring in the use cases around the tokenized assets. It can't just be on-chain capital holds, off-chain tokenized money market funds, because at some point, rates go closer to zero, compound and Aave rates, deposit rates go to 5%, and then money flows from the tokenized money market funds back into compound and Aave, right? So I think use cases like exchanges allowing for tokenized money market funds as collateral, and that doesn't just have to be crypto exchanges, by the way. That can be, as Chris pointed out, SIBO, CME, using tokenized money market funds for the T+0 settlement, right? And the efficiencies that the hedge funds who are their consumers get from those products. And so I think that takes time and that takes convincing. That's why I think stablecoins, which have less regulatory challenges and are sort of a more natural transactional asset, are probably a better beachhead market than like tokenized assets where transferability of securities itself is something fairly contentious, right? And there's real limitations around transferability of securities. And so I think if and when regulators start to understand the benefits and those things unlock, then we'll see the use cases kind of follow. I mean, I think programmability largely as a final meta theme, programmability, computation on top of financial assets is something that really hasn't, existed before. And unlocking that and opening that up to an open source community of developers, I think will just reap real rewards that we can't foresee today as well.
If I could build off of something, there's still so much foundational work that needs to happen. And again, 200 billion is tiny. It's a drop in the puddle. What is some of that that foundational work? Well, gosh, you can move these tokens throughout the system very quickly. But what happens when the music stops? Like, does an institution have perfected recourse to the underlying value? And so there's an entire tidal wave. The lawyers are so happy of how to create perfected interest for the collateral use case, as an example. And institutions really can't adopt these new assets as collateral until that foundational work is complete. So I really think we're still at the very beginning of the story, not the middle or the end.
Okay, what is immediately clear? There is a problem and there's a solution. But what I want to shift the lens now is on value capture. And I'm going to split the panel into half, right? So Rob and Ash, I would like you to talk about value capture as a business model, because there's so many tokenized players out there, startups that are trying to play in this space, tokenizing all different kinds of assets. But most of the time, they don't charge much fees, or at least we don't see them, right? And those fees that we all lambast these financial institutions for are also what make them this trillion-dollar or multi-billion-dollar organizations, right? Like your traditional bank. So these guys have the highest ROEs precisely because they thrive on inefficiency. So would love to hear both of you comment on the value capture as a business, as a business model. And then what I'm going to shift gears, Chris and Will, right after that, is talking about value capture as investors, right? Because exactly to your point, Will, beyond Ondo, we haven't really seen a $1 billion sort of token outcome. Well, I guess we just saw the news on the first $1 billion equity outcome with Stripe's acquisition. But where does value capture lie? So 2 different angles. Let's start with Rob and Ash.
Yeah, so on the value capture side, I think, to your point, there hasn't been a lot of fees, there hasn't been a ton of revenue in this space, but there is actually clear value capture right now at places like Broadridge, right? So Broadridge is doing $1.5 trillion a month of repo on-chain. It's private permission chain, doesn't accrue value to, call it, the rest of the crypto ecosystem, but what it does do is for all of their counterparties, everybody who's trading, there's clear savings on the costs of doing that business, right? And so there is value there, but there hasn't been top-line value, it's been bottom-line value, right? I think when we think about the, maybe the protocol side, right, and people have built into the space, again, the when people are thinking about, okay, well, equity versus tokens, et cetera, like the tokens have had maybe mimetic value, but, Ondo and I hope, maybe Justin or Nathan are in the room and they'll hate me afterwards. But like they do less than $1 million of revenue. The token trades at $9 billion, right? This is because there's a mimetic trading value to it, but it hasn't been, one that has like equity value. And the equity value for at least the startups in the space have almost been entirely at like the transfer agent level, the legal level, to Chris's point, the lawyers, it's been a consulting business, a banking business. It hasn't been a tech story to date.
Yeah, I completely agree to that. Absolutely. I think one of the biggest things that I've also kind of realized in a bunch of these conversations with financial institutions, and to your point, I was also talking to State Street, which is also close to 3 to 4 trillion in AUM. They have tried so many different types of tokenized treasuries. I mean, this is not like the BlackRock of like $500 million tokenized treasury. They've tried so many different models of tokenized treasuries. They've tried to kind of create their own interoperable framework. They've tried to create their own different avenues and actually, sort of begun like creating a DeFi protocol as well. But to your point, it's extremely hard to get that kind of value capture out of this market today. That's why I think my fundamental belief will always be that equities, especially in the RWA space, which is generally, in my opinion, slightly an underserved area, both in terms of talent as well as capital, can actually potentially create that tech story that we're looking for. That tech story which basically revolutionizes the way we perceive RWAs, and it goes beyond the mimetic trading value that we see today.
I'll chime in then. Let's start with Tether. Tether's more profitable than BlackRock, as I understand it, right? So there's definitely value capture there and value creation. Obviously they don't have the token is USDT, so there's an equity play.
I think we do need to like pull apart the stable coins versus the rest of the ecosystem a little bit, though.
Okay, so let's talk about Superstate, which is another one of our investments. Yeah. That's a traditional asset management model, but then with a really interesting hook because they can navigate, the decentralized finance space perhaps better than some of the incumbents. So I think we're super early. There are going to be a myriad of business models and use cases, whether it's the asset management use case or the stablecoin use case you don't want to talk about.
Well, it's just so obvious.
Yeah.
If you're like,
It's still a banking or consulting, in my opinion, or lawyers.
I mean,
right? Like it's basically these are the three.
To Chris's point, though, like Tether and Circle, in some ways, are asset management business models. Like fundamentally, at their core, I mean, Circle would probably push back on them being an asset manager, but I think they're an asset manager who captures a really fat expense ratio today, and that expense ratio may be getting competitive pressures both from the downside from companies like Agora, from tokenized money market funds across the space, whether that's Superstate, Hashnote, or the myriad of others. Obviously, BlackRock's Biddle fund as well. They may be getting margin compression on the top down from just rates falling as well. And so, I think asset management business model is true both on the issuer of stablecoin side and the issuer of RWA side. I think there's a clear business model we've seen on the stablecoin side, which is a more transactional business model that you take a percentage of the a very small percentage of the kind of flows that you get through your system. Obviously, you mentioned Bridge, which was acquired by Stripe. That's a business that has that kind of quality. There isn't sort of a corollary on the RWA tokenized asset side at the moment where there's like a transactional business model. I think just to speak to the tokenized asset RWA asset issuer asset manager business model, it's just very hard, and it's hard to see large-scale outcomes at the moment. You can obviously say the numbers get so big in 10 years that you can justify it, obviously, but you're talking 30 basis points if you're lucky, expense ratios, and the asset base you need to achieve versus the on-chain capital base that you sell to feels really mismatched at the moment. And there's some really tremendous founders who are able to raise capital because they're very talented, but I think the valuations and the asset basis right now are at a mismatch. I would be interested in looking for that transactional business model. What's the transactional business model in RWAs as there's flow through the system? But again, stablecoins are more transactional inherently. They have flows, whereas you don't really, if you're holding a private credit fund on chain, like you're probably not sending it around to people too often either. So I do have some doubts about value capture for issuers and RWAs for the time being.
Yeah, and I think it's really interesting because if value capture is somewhat unclear, then let's layer on that challenge of return timelines, which all of us are fund managers, right? If today we invest in this space, this industry broadly, it's quite different from other verticals like, say, DeFi, like gaming, where you launch a token, generally within 2 to 3 years of investments, you expect early liquidity. But what I'm hearing, a 2-decade timeline, value capture is unclear. Kind of where do you see the returns accruing for us as investors in this space, right? Because sure, for startups, it might be a 1-2 decade timeline, but our fund cycles don't operate by 2 decades, right? It's often even less than 1 decade. So what are your views around this?
I'm going to start on this one because I want to bring back like a thesis we were playing with about a year and a half, 12 to 18 months ago, essentially, which is in the RWA tokenization space, is the winning approach going to be, the businesses like Securitize and Securrency, who are fundamentally attempting to be software platforms who then sell into large asset managers the ability to tokenize their assets. And for a while, that was a pretty slow, that was a bit slow going, and there was a lot of infrastructure build out that you had to do. The other approach, obviously, is be an asset manager, verticalize down into the actual software stack, launch your own products, and then scale your own products, and just be a true asset manager with a real differentiation that you can actually interact with the kind of future financial rail in the form of Ethereum or Arbitrum or Base or Solana or whatever. And for a while, it looked like the verticalized asset manager was like actually the right approach because there was a lot of cash burn at some of the earlier startups, and then all of a sudden, like the BlackRock and Securitize, partnership with Biddle kind of took me by surprise, and so I don't have a clear conclusion to that question. I do think the software business model is probably better for the immediate term. Like you can sell across a wider variety of customers and kind of get those revenues, going faster. I think maybe longer term, the compounding of being an asset manager and getting to the scale of a BlackRock or a Blackstone or a KKR or somebody else like that, you can get a really fantastic outcome. But and obviously there's the token. When I said 2 decades, I don't think like we're betting on one company over 2 decades. I think there's going to be a couple generations of turnover that we experience between now and then.
So that's very interesting, and that's, I think, slightly different from the sort of mindset and the approach that we have, especially in conversation with LPs. So I think the asset manager approach definitely can work and should work over the next couple of decades with the churn as well. But I think from like an institutional venture fund lens, we've always had this position that any investment that we've done for less than a decade is actually not a good investment. Right? That is basically the mentality and the kind of LPs that we come with. So for example, Wise is at this point, like a 16, 18-year-old company roughly. We did the pre-seed for Wise and we are still investors. So we did the pre-seed, the seed, then I think 4 other rounds later as well from like our growth and late stage funds as well. So I think there's an entire argument to be made that for actual real value in the tech industry from like a software lens specifically to be created takes time, and that time needs to be like in the double digits when it comes to years, and it cannot be in the single digits because then there's automatically like a ceiling or a cap to the quality of the sustainability of the business that you can actually build out in like 4 or 5 years, and how many hands or how many lives it's actually touching. I think like venture industry is incredible because we always talk about venture scale, and I think it's the scale that we need to capture and then scale it up further to make a sustainable business. So I think from that lens, I think our perspective is that and to LPs as well, we never talk about how quickly exit liquidity will be part of the fund. The minute we do that, we're actually just going to recycle the funds anyway. So it doesn't really kind of create substantial TVP or DPI for the LPs anyway.
Yeah, maybe I'll add a little bit of a different perspective, and I'm actually interested if you're going to agree with this point. But that's all well and good at a generalized fund, right? But so our LPs are institutional. They are people who are endowments, pensions, like sovereign wealth funds, right? They're the same type of LPs that you have, right? Our LPs look at us and they say, okay, well, this is my crypto bucket. And in my crypto bucket, I also have other funds that do token investing and equity investing. And what I have found surprising in those conversations is we're 2.5 years into our current fund. I am already having conversations about where DPI is, right? Nobody would have ever asked me about DPI if I was in a traditional fund, right, at 2.5 years. And it would never have happened. And the same LPs
never.
that you and I
Yeah,
have.
absolutely. Yeah.
And so what ends up happening is there's this incentive kind of misalignment that really kind of plays on itself. Whereas people say, okay, well, we see these tokens launch, so we see other people getting DPI, so are other funds returning capital. So we want some capital back as well, because we know, like, oh, well, part of the good thing about crypto is that we get capital quicker, right? And so our approach has always been to be really long-term investors. I was just telling somebody else, we led the seed round into Avalanche. We still haven't sold a single AVAX token, right? And we rode it all the way up in 21 and all the way down, right? And that's been our approach as well. But more and more, what we hear from the LPs is, hey, like, we do want quicker liquidity because there hasn't been as much liquidity, because there is this world in which, other crypto type funds are returning capital. And so I think it's, for us, a little bit of a push-pull. We do take a long-term mindset. I think 30% of our portfolio is equity only. Like, we, and we invest in things that we think will do really well. We want to keep the LPs happy, but sometimes you just have to tell them, hey, we're going to do the things that we think will make you the most money over time. But there is, I think, a little bit of misalignment that's happening in the space right now.
I think maybe just word the narrative that there needs to be like a specific separate RWA fund within Dragonfly next. I think that's on the cards now.
Well, that's what we've done. We don't have a specific, I don't say the R word because I'm a banker and it just makes me crazy, but we don't have a separate tokenized fund, but we do have separate strategies for seed, venture, and then liquid. So if people want, annual DPI, go into the liquid strategy, right? Getting back to the business model, look, we're long-term investors. The thing, if you focus on the asset management vertical, it's a tough business. And look what's going on in TradFi right now. The bigger getting bigger, you're seeing massive consolidation. The reason why is because you have regulated businesses, fees are getting tighter, and so you have to scale. The good news is that as we move out of the $2 trillion crypto industry into the multi-trillion-dollar traditional industry, the numbers can get big fast. And so hopefully we find the right investments that are able to scale into that value over 7 to 10 years.
So you're not getting pressure to return capital?
Everyone gets pressure to return capital.
I mean, it feels like the sort of equilibrium for all investors in the space is you have to be balanced. You have to have a long-term mindset. Well, you can't miss the stuff that obviously produces extremely high IRRs, right? And there are, I think RWAs are a tricky space for tokenized assets, right? There's this kind of centralized administration that has to be done with some of the legal contracts behind the scenes, and hopefully that is something that gets worked out with regulation. And so I'm not sure it's a perfect space for token issuance, but you can't miss a new approach at a business, the new correct approach at a business model that has an attractive IRR. So our perspective is you have to just approach it with balance and take really talented entrepreneurs at their word and let them go pursue their particular approach, right?
And maybe I'll just put one fine point on that, which is like, that is kind of how we've approached the space too, which is like, okay, if it is net new on-chain and if being on-chain allows something to be enabled that wouldn't be otherwise, like that is where we find it very interesting. And so we're investors in a thing called Parcel, people may or may not know, but they have a really interesting data business that does not exist otherwise outside of what they do, and that enables them to do on-chain trading in a way around real estate that you couldn't do otherwise. And that's the type of stuff where we try to focus a lot on. And it is a long-term game, but there's also things like, there is a crypto piece to that is very unique versus just, hey, let's stick a traditional asset on blockchain.
All right, we're almost at time. So one final challenge to all the panelists. Today, one of the LP calls you up and says, how do I approach this RWA thing that I'm hearing about? What would you say to them?
Yeah, I think my LPs are going to expect a very different answer from the remaining LPs here. So I've actually been asked this question. So we are also doing our sort of fund close actually next week of our latest fund. And one of the questions that the LPs asked me was, if you're investing in blockchain and broadly in the real world asset space, where exactly will you park the capital today? And the answer that I gave to all 4 of the LPs who asked me this question was, anywhere across asset ownership to sort of innovative financial networks, as well as Rails, would be sort of our top of bucket in terms of where we want to invest.
Yeah, I mean, stablecoins payments, the most obvious use case. I think we all agree that is where a lot of value is going to accrue. And then after that, invest in Dragonfly and we'll make good decisions for you.
We're spending a lot of time in stablecoins and payments, as Rob said. I think, we do the infrastructure, like all the way down to the infrastructure layer, like every layer in the stack we're interested in. I would say I'll make a specific, just to do a twist on your question. Specific request for a startup is somebody building an FX DEX, so like an on-chain DEX that trades a variety of G7 currencies. What, do you already have that?
You took mine.
Okay, well, sorry.
Sorry, didn't Galaxy incubate a company doing
We
exactly
could incubate a
that?
company
I mean, you
doing
did already, I thought.
No, well, it's complicated, but
Okay.
we have a portfolio company that's doing something similar, but not like right on that theme.
Yeah, I think you guys made great points. The opportunity set, the FX opportunity set is just like staring everyone in the face.
Completely.
Yeah, yeah.
$7.5 trillion a day, all of it's dollars. The world is a better place if we move away from that because of the instant settlement. The current system is not very accessible. There's one centralized player. Rob and I have talked about this as well. So that's a really interesting vertical. And yeah, tokenization, I think, is going to remain an important vertical of many across our space. And hopefully we do make some good investments and it results in good diversification.
All right, ladies and gentlemen, join me with a warm round of applause to thank our panelists. Let's do a selfie against the crowd. Yeah.